Hello traders, welcome back to my channel. I am Cosmos right here with Black Bull FX, and today we are going to be diving deep into a very powerful trading concept known as the ICT Power of Three. And this strategy, developed by the inner circle trader ICT himself, is a game changer for many traders, guys. And I'm so excited to break it down for you today. So let's get started. Okay. Well, understanding the ICT Power of Three. The ICT Power of Three is a comprehensive trading strategy that it revolves around three critical phases in the market, and that is accumulation, manipulation, and distribution. And by understanding these phases, you can anticipate market movements and make more informed trading decisions. So let's go through each phase into detail, guys. All right. First, we have the accumulation phase. This is where smart money or institutional traders accumulate positions here. The smart money and institutional players are stacking several positions right here, guys. Several, it could be a buy or a sell position. They're just stacking as many as they can here, right? And during this phase, the market often moves sideways within a range, all right? Within a range. So guys, with quite some sort of low volatility, like the market is not showing any like upward or downward move like straight. Okay, so it's just ranging. So retail traders usually do not notice this kind of phase in the market because it looks like the market is going nowhere. So I've had so many guys always say during a ranging market, it's better you stay out of the market. So people think there's nothing going on here, but what is going on here is that the groundwork for a significant move is being laid here by the smart money and the institutional players. All right. So the key here is to identify the areas of support here. Your area of support here and the area of resistance. It's very crucial, guys, very crucial, right? So if you get to know these key levels in the market, then we can know what's going to happen in the next phase. We'll wait for the next phase, and we see, and the next phase is the phase of manipulation. Okay. This is where the market makers or the institutional players manipulate the price to trigger stop losses, which were here, and create liquidity into the market, right? And what we know is that liquidity is money. Every time you've been liquidated, your money has been taken and somebody is taking it. So they trigger your stop losses, you lose money, create liquidity here, and you might see a sharp move in either direction, depending on, for example, in this case, this is for a buy. So we expect a sharp move to manipulate guys like it's going to sell. Then we see price breaking, often breaking through this support right here to be manipulated, grab liquidity here, and then price move rally back up so fast, right? This is just designed to mislead retail traders and shake them out of their positions. So for whoever had put a buy position here and put their stop loss here, they have been taken out. They have been taken out. They have been liquidated. All right. So during this phase, it's essential to stay really patient and not fall into the traps being set by market makers. Don't act so impulsively to like say there's been a breakout, here, so you need to enter position so that you don't miss the move. You'll be liquidated. All right. So the price comes down, sweeps all the stop losses here, create liquidity, and that leads us to the next phase, which is the phase of distribution. All right. This phase here is where the actual move happens, and after accumulating positions this side here and manipulating the market to create the liquidity here, then the price starts to trend in the intended direction. So once you see this manipulation on the downside, the intended direction of the trend would be bullish or an uptrend. So when accumulation phase has taken place, manipulation has taken place, then price begin to rally into the intended direction of where the market want to go that day. And this phase here can be the most lucrative phase because if you identified all these so rightly, got this right, then you're going to ride this guy. Your goal is to ride the trend and maximize your profits. So you would stack in positions like here, and make sure you always watch out for other institutional, reference points like fair value gap and order block, which is always somewhere here. Somewhere here will be your order block, and maybe a fair value gap could be somewhere here. So that's why you stack in positions, and you watch price go your way, guys. You maximize on the profits. All right. So let's put it all together. Imagine the market has been in a very tight range, like we saw in this case here. All right. And this could be like for several days, 2, 3, 4 days. You just ought to be so patient, waiting for your move, guys. Okay, all that it takes to be profitable in the market is like one of the attribute is to be patient. All right. So the accumulation phase takes place, and then suddenly we see a sharp move. All right, we see a sharp move to the downside, breaking this support right here to the downside, and then breaking the previous low here. And as we have just seen with this, we could say this could be a manipulation. Yeah, sometimes price may break because we really don't know what the market is always offering. Nobody knows where the next move is going to be, but we only anticipate, right? So if we see this, we wait for this manipulation to take place, and we confirm with the other confluences to see if the market is willing to go up, and we ride the trend, right? And that will be our distribution phase. All right. So that is it, man. So to effectively trade this strategy, you need to be able to identify the accumulation phase, where you look for periods of low volatility and sideways movements in the market, and then you mark your resistance and your support levels. Then you recognize the manipulation. In the manipulation phase, this is where you ought to be so cautious of sudden sharp moves that break support or resistance levels. And these moves, you must know that these moves are basically designed to mislead you into thinking that the price is going to move up or continue to move down, when actually it's just a manipulation. And if you have identified all that, the manipulation has taken place, then you write the trend with the distribution, guys. In the distribution phase, you write the trend. Okay, you follow the direction of the trend, enter your positions here, write the trend until you hit your target profit point. All right. And in all this, you got to know that risk management is very crucial throughout all these phases right here. You need to know that you must always use your stop losses to protect your capital, and also ensure that you have a solid risk to reward ratio. Normally, a risk to reward ratio of 1:2 is ideal. Okay, 1:2 or 1:3 at most. If you want to go that more than that, I think that will be like unrealistic. Okay, because you need to put realistic risk to reward. Realistic risk to reward. Uh, the market doesn't move in one single trend forever. At what point it has to reverse, and you need to protect the money you already made in the markets, or you protect your capital. Okay, it's very, very crucial, guys. So to recap, the ICD Power of 3 involves understanding and identifying the accumulation, manipulation, and distribution phases in the market. And by doing so, you can anticipate the market moves and position yourself for success, guys. Remember, practice always makes perfect. Keep studying the charts to be able to see all this and backtest your strategy and refine your skills, guys. And that is it for today, guys, on the ICD Power of 3. And if you found this information helpful, please give this video a thumbs up, share it with your fellow traders, and don't forget to subscribe to my channel. For more trading insights, leave your questions and comments below. I would love to hear from you. Until next time, happy trading and peace.